Welcome back to the Global Ledger. I'm Justin. Today's episode is part of our Mythbusting series, where we slow down the headlines and try to rebuild the story from the balance sheets up. And today's myth is everywhere, and it has been for the past couple weeks. And that is Japan is about to break the global financial system. The yen carry trade is unwinding. The BOJ has lost control, and when Japan cracks, everything cracks. I think everybody else has heard this story before. It sounds scary and very systemic, but it's wrong, or at least wildly misunderstood. Okay, so today I'm going to explain what Japan is actually doing, and why it might look unstable too. And also why it isn't the systemic time bomb people think it is. Let's get into it. Why does Japan always look like the problem? Here's the thing you need to understand. Japan is not a normal country in the global financial system. Japan is a funding node. Not a demand node. For decades, Japan has sat at the bottom of the global interest rate hierarchy. As an example, low inflation, low growth, low yields, persistent excess savings. That makes Japan a source of cheap funding, not a source of global stress. So when rates move, Japan doesn't cause volatility. It reveals it, okay? Every time global rates rise, you'll see these headlines appear like carry trade unwinding and the Bank of Japan is trapped, or in some kind of global contagion, or the yen's collapsing. But notice something important, okay? We've been hearing this story for 20 years, and yet no Japanese banking collapse, right? There's none of that going on. No failed JGB auctions or anything of that nature. No forced deleveraging spiral originating in Japan either. This is structural, okay? This is structural, okay? So let's go into the carry trade myth. I think this is probably one of the most widely spread. And we're going to tackle this. We'll tackle it head on. Okay. So when the yen strengthens or weakens, the carry trade will unwind and crash markets. This is the story. This is what people are saying. So here's the problem with that. The yen carry trade is not one trade. It's not even one lever. And it's definitely not just a single balance sheet. It's a diffuse funding strategy spread across hedge funds, banks, corporates, sovereign reserve managers, long-only institutions, multinational balance sheets. There is no red button labeled unwind carry trade. It's just not a thing. Not a thing. Most yen funding is hedged. It's rolled, maturity matched, and embedded inside broader portfolios. When the yen moves, positions adjust gradually. Margins change as well, and hedges get repriced with this. And funding costs shift. That is not the same thing as forced liquidation. Markets don't break because prices move. They break when settlement fails. Japan has not failed any settlement. And so we need to address some of the bigger claims that are spreading online. Because I just want to pause and respond directly to specific kind of narratives that are spreading, because it's a perfect case study in how the myth gets built. Okay, and I'm not going to name any names. I'm not going to do any of that. I keep things core, centralized, respectful, and that's it. That's it. Because nobody knows everything, and so so you'll see videos claiming something like this. Japan is flying under the radar, but it could directly impact your stocks, your bonds, and definitely crypto. Okay. That's one I've heard from other creators. Another one I've heard is Japan is the 4th largest economy in the world. Okay. I've even heard some people say it's the 3rd largest. Japan has one of the largest treasury markets. I've heard that too. Another one, there's a 20 trillion plus meltdown, or I've even heard 30 trillion plus meltdown coming through the Japanese yen reverse carry trade. Okay, another one. Japan funds massive global leverage. That's another. Another is if Japan loses control, markets won't adjust slowly. It'll be chaos, forced selling, and a freeze. And lastly, maybe the Fed is even doing reserve management purchases to prepare for Japan-triggered treasury selling. Some of these statements. So I've got 6 here, I believe, 6 or 7. Some of those statements are partially true, but the conclusions drawn from them are structurally wrong. So let's correct the major claims, okay, cleanly, in a clean manner, and without any kind of hand waving either. Okay, so claim number 1: Japan funds a massive amount of global leverage. Okay, Japan has been a low rate environment, yes. Okay, in a very low rate environment. The yen has been used as a funding currency. Both of those statements are true. Okay, but the leap from that to Japan funds trillions of leverage that can unwind all at once, there is no support for that, because funding does not equal leverage. A huge portion of global yen exposure is FX swapped, hedged, netted, rolled over time, and held by institutions that are not operating on daily margin in the way retail leverage is imagined. There is not one $20 trillion trade. There is not one unwind event, and there is not one forced sell button either. It's distributed across balance sheets in time. Okay, so that's the first claim. The second claim we need to discuss is this: that the BOJ raising short rates breaks carry math and forces liquidation. Yes, short-term rates matter, but they don't flip the world overnight. If the BOJ moves short rates from slightly negative to slightly positive, that does not automatically turn trillions into a loss. Most major players hedge the FX exposure, manage duration risk, ladder maturities, and refinance gradually. That's not everyone sells today. That's the system reprices over time. Very important. Okay. So that's claim number 2. Claim number 3, long-term Japanese yields surging means the BOJ is losing control. Long-term yields rising is not a synonym for system failure. A bond market can reprice and still be stable if a couple things happen. Auctions clear, settlement remains continuous, bank funding remains intact, and there is no external FX mismatch that forces liquidation. Japan borrows in its own currency. Its banking system is deeply domestic. Its central bank is the ultimate backstop. Okay? Excuse me. If yields rise, that can mean policy normalization, risk repricing, or term premium changing, not necessarily loss of control. Okay? Another really important claim to address. Claim number 4. If everyone needs yen at once, it's catastrophic. This is where the story becomes a little dramatic and inaccurate. Okay, FX funding is largely intermediated through dealer balance sheets, swaps, netting, clearing, and maturity transformation. The system is literally designed to prevent the cartoon version, if you will, of everybody needs yen at the same time. If that were the true structure, global FX markets would have collapsed a long time ago. They haven't, because the plumbing exists precisely to manage this. So that's the fourth claim. We got three more, I think, that are important. Japan, the fifth claim, okay? Japan is the silent driver of global liquidity. This is the closest claim to true, but it's still misleading as stated. Japan has been a source of low-cost funding at times, but Japan is not the dealer of last resort for the global system. The currency that anchors settlement at the top of the hierarchy, especially in crisis, is still the US dollar system. Japan can influence global pricing at the margins, but it doesn't control global settlement capacity. Extremely important. Number 6, Japan caused a 14% decline in US dollar to the Japanese yen and a 6% S&P slide. This is a classic correlation story. Markets move for many reasons simultaneously. The examples can be global rate repricing, growth expectations, positioning, hedging flows, U.S. data, Fed expectations, so on and so forth, risk sentiment. So Japan is often a visible narrative anchor people use to explain the move. But that doesn't mean Japan was the primary causal engine, right? The point is this: even if the move happened, that doesn't prove Japan is breaking the system. It proves the system is sensitive to funding and rates, which is what we've been saying. So the last claim, number 7, is the Fed buying T-bills for Japan selling treasuries. This one is a big red flag. It assumes a direct pipeline from BOJ hikes to carry trade forced unwind, mass treasury selling, and then the Fed buys bills to prevent chaos. That story skips the real plumbing, the real structure of the system. It skips the real plumbing: who holds treasuries, what's hedged, what's funded overnight, what's term funded, which dealers intermediate the selling, what the collateral channels look like, what actually pressures repo and bills. Fed bill purchases, when they happen, are primarily about reserve management and money market functioning, not about preempting a Japan doomsday scenario. So even when the Fed acts, it's often addressing U.S. money market mechanics, not foreign headlines. Okay? So those 7 claims I kind of picked out of the dozens of videos that I have seen and watched thoroughly on YouTube. And I thought those were probably the most worth addressing. There were others. But I want to start talking about what the BOJ is actually doing. Okay, so we've put that aside. We've addressed that. Now let's talk about the Bank of Japan, because this is where fear, I think, concentrates the most. The BOJ holds a massive share of Japanese government bonds, domestic assets, and it has been willing to intervene aggressively. People see this and say they can't exit, or they've monetized everything, or they're trapped. But this misunderstands what the BOJ balance sheet is for. The BOJ is not trying to optimize market pricing or protect foreign investors. The BOJ exists to anchor domestic funding conditions, stabilize Japan's financial institutions, and preserve settlement continuity. Really important. Yield curve control wasn't just money printing. It was a domestic market structure choice designed to avoid forced deleveraging inside Japan's institutional system. And the most important thing, the BOJ never lost control of settlement. JGBs continued to clear, banks continued to fund, and payments continued to flow. from a global ledger perspective, that's the core system stability criterion. Okay. So why is it that Japan isn't the systemic risk people think? There's some key distinctions most commentary misses. Japan is not leveraged in foreign currency the way fragile systems are. Japan borrows in its own currency, funds its own government domestically, clears its own payments domestically, has a central bank aligned with the fiscal authority. That means Japan does not face the classic emerging market doom loop, as we've discussed before, like FX mismatch and dollar funding stress and external rollover risk. Look at, Argentina as an example, as an emerging market. If the yen weakens, Japan absorbs it internally. Import prices adjust, and policy responds gradually. That's very different from a system that has to find dollars to survive. Japan is not Argentina, and Japan is not Turkey. Japan is a controlled experiment in monetary endurance, if you will, not a sudden systemic tripwire. Okay. What Japan actually signals is an important part of this. Okay. So if Japan isn't breaking the system, why does everyone panic every time it moves? Because Japan is a mirror. Japan reveals global duration stress, cross-currency basis pressure, shifts in funding hierarchies, and tightening or loosening dollar conditions. When Japan moves, it's often telling you something about global liquidity, not Japan imploding. Japan doesn't start fires. It shows you kind of where the smoke is, if you will. So these videos are really convincing. And so why is it that these narratives kind of feel so believable? Because they combined, in my opinion, they combine real history, like Japan's bubble, real mechanisms, carry trades, big numbers, 20 trillion, right? And fear-based timing, like right now. But they collapse structure into story. They confuse funding with leverage, volatility with insolvency, repricing with crisis, and headlines with the structure and the plumbing of the system. And that's how I think myths spread. So the real takeaway here is, and the real myth we're busting is Japan is not breaking the global financial system. What is happening is more precise and more important. Global funding conditions are repricing, duration risk as well, and cheap carry is no longer free, right? The hierarchy of money starts to reassert itself in a higher rate world. Japan is, it's not the bomb, okay? It's just not. And if you want to understand what's actually fragile, you don't start with thumbnails and fear. You start with settlement. You start with balance sheets and funding mechanics. And that's the global ledger view. So I want to thank you for listening to one of the longest episodes we've had on the channel, but it was an important one. It was episode 2 of our Mythbusting series about Japan and it possibly breaking the global financial system. The next episode, we're going to return to our normal series and the global dollar system applied, ARC 7. And thank you for listening. I'm Justin, and thanks for being here.